Good morning, everybody, and welcome back to Beat the Bell. I hope that everybody had a phenomenal weekend. I know that I did. It's a new week of trading with new opportunities, and we are excited to guide you along here on the show. Let's bring in today's panel, starting with Money Mander. Money Mander, good morning to you.
Good morning. Happy Monday. Another week for some more craziness. We'll get into that in Fed forecast coming up next.
All right, Diamond Trades, good morning.
Good morning, guys. Excited to get into it. As you see, I have my markets in turmoil background behind me. Very fitting for what we're going through right now. Let's get into it.
It's time. It's time. Ramsay Rippers, good morning.
Good morning. Markets in turmoil. I like that, Noah. Excited to see how the week unfolds. CPI tomorrow morning. Let's get after it.
And Moe Mamba.
Good morning, Hondo. Crazy, dude. I'm just seeing this right now. Futures are red. What the fuck is going on? Let's get into it, man.
Futures were ripping last night.
Yeah.
Not so much anymore. All right, let's get straight into Fed forecast, economic outlook. What do we got?
Yep. So we can go ahead and start with the economic calendar for this week. Not quite as crazy as last week, but still some pretty important movers on there. We have CPI tomorrow, and then retail sales and PPI on Wednesday, followed by jobless claims on Thursday, plus some housing market data, and then UMISH sentiment on Friday. So a pretty busy week in regards to news. But let's go ahead and just do some housekeeping and clear up the biggest news story of the weekend, which is obviously the entire Silicon Valley Bank debacle. So we can run through a very quick timeline of essentially what happened there. And then we can move into what that will mean for this week. So basically this whole thing started with SVP essentially had held a bunch of bonds and cash, right? When bank customers deposit their physical cash, banks will essentially hold those in either cash or available for sale securities. SVB in particular had their customers in bonds, right? And so when people want to come in, withdraw their money, they use that cash. And then if they don't have enough cash, they use that available for sale securities. They had a lot of outflows in the bank. And so they decided to sell some of those available for sale securities. They had about 21 billion, and they sold them at a loss, right? Because as interest rates rise, bond prices go down. They had a loss on that bond portfolio, had to sell it at a loss, lost $1.8 billion. The next day, they announced a capital raise to essentially cover that hole that they lost. We lost 1.8. Let's raise 1.8 to shore up our balance sheet. Investors kind of got spooked. Why are you guys raising cash unless there's something going on? Do you guys have a liquidity problem? Everybody gets scared, and the stock drops massively. This is on Thursday, right? So after they announced that capital raise, panic ensues. You had a classic run of the bank basically Thursday and Friday as more than $42 billion in deposits tried to leave SVP, basically on fears that they had liquidity issues. And that is when, shit sort of hit the fan. Management attempted to sell the firm on Friday, right, as they realized that they were having this liquidity issue. And they ultimately couldn't sell the firm. No buyer stepped in, and that's when the FDIC seized control of SVB on Friday. So that's basically the timeline of events that went down with the bank themselves. Over the weekend, regulators decided to step in to essentially prevent this entire thing from spreading, prevent contagion. And so on Sunday, just before the futures open, the Fed said it is closely monitoring the situation across the financial system and is prepared to use its full range of tools to support households and businesses, and will take additional steps where appropriate. The central bank said it would make additional funding program available to banks through a new bank term funding program, which will essentially provide banks with an alternative to liquidate their bond holdings when in need of liquidity to meet deposit outflows, right? So that's meant to deter additional bank runs going on this week. And so that's how they decided to basically stem some of this panic. We'll see if they did a good job. But so far, the markets seem to have liked it last night, initially popping like 60 points before, as Mo mentioned just now, trading back in the red to start the day here. People are questioning whether this sort of recent stress that we're seeing right in the banking system is going to cause Feds to essentially pause their rate hikes, right? At one point, we had 50 basis points pretty much baked into the cake for the March meeting. And now you have a situation where the financial system is under a bit of stress. Does Powell want to raise 50 basis points into a situation like that? Mander, what do you think?
SVB, which is obviously the story to cover here. We also have CPI coming out tomorrow, so we'll hit that really quickly. Expectations coming in at 6.1 year over year versus 6.4 actual last month. Month over month expected at 0.5%, still positive and equal to last month. And then we have core year over year at 5.6, equivalent to last month, and then month over month at 0.5 versus 0.4. So really CPI and inflation not expected to cool whatsoever. So I think as we get into CPI this week, PPI this week, not expecting any cooling going on at all, right? Retail sales increased last month, and the economy added 800,000 non-farm payrolls this year so far. So I think Powell's kind of in a tough boat here. And I don't think anyone wants to be the Fed right now, where you kind of have to choose a lesser of two evils between, do you kind of keep trying to cool inflation as is your job, or do you kind of support the banks here, right? Because obviously by increasing interest rates here continually and going more hawkish and jumping back to 50 basis points, you really run the risk of a global and or at least a nationwide bank run here. As you said, I don't think SVB was the only bank in this situation here, because they were mandated to hold treasuries, right? I think after the crash in 2008, banks were required to hold X percent of total assets on the balance sheet in treasuries and or cash. And so by holding cash, you lose money. Banks were all holding treasuries. I don't think SVB was a one-of-one situation. So Powell's got a tough job on his plate this week. I think we have to see really how hot these numbers come in. If they come in at 7%, he doesn't really have an option, I don't think. But if they come in as expected or at least around expected, he's got a tough decision to make here. And as you said, the Fed fund futures have been moving like SPX 0 DTEs lately. First, a month ago, had 10% chance of 50 basis points. Then last Thursday after the testimony had an 80% likelihood of 50 bips. And now back down to less than just 2%, 98% chance of 25 basis points after the SVB crash. One thing I wanted to note on, I think we're finally seeing this recessionary safe haven trade. So far this morning, the 2-year yield is down the most it's ever been in the last 35 years. Investors are flocking to treasuries right now. It's actually down over 100 basis points just from last Wednesday, the 2-year yield. So bonds are getting eaten up. I think maybe that's what would have flipped futures red so far this morning. The second the bond market opened at 8 a.m. Eastern, I'm expecting money just flew out of stocks into bonds. So really, I guess we'll see, right? To me, it feels like people are starting to get this bank run and recession fears coming in, as we're finally starting to see not an inverse relationship between yields and stocks, but a direct relationship where yields are dropping with stocks as we're seeing outflows from stocks into bonds.
Right. One of the things that you hit on is that there's other banks most likely in SVB's sort of scenario. And I think one interesting thing is that they sent an email to their customers early last week, basically talking about how they had, they were strong in terms of liquidity and that they were above all of the regulation thresholds, right? In terms of the amount of cash that you need on hand or the amount of liquidity that you need. And yet something like this still happened. And I think one of the things that I saw talked about a bunch over the weekend was the speed with which this sort of unfolded, right? Where in one situation, in one moment, it seems like you're more or less financially sound as a bank, and then 24 hours later, you're getting taken over by the FDIC. I think the speed with which people can move money now is definitely impacting the way that these banks are working, in the sense that you can technically on paper look pretty good, right? And that's what SVB really did. Like, they didn't look quite that bad on Wednesday, right? And then by Friday this happened. So I think that's what has people a little bit worried. I do think that with the Fed's aggressive moves yesterday, I think will probably prevent literal bank runs, throughout this week. I think we'll have to wait and see, but it seems like they definitely stepped up to the plate in that regard. But in terms of your question about the bips, I would have to, like you said, 98% of 25 basis points. I just can't see a 50 bip raise, after what just unfolded. Personally, I can't see it unless, like you said, inflation comes in like 7%, something ridiculous like that. It seems like 25 basis on the table. I also don't think they're going to pause, though, to be quite honest. I've heard some talk about that, about how, there's some stress in the financial system. Maybe they'll not even raise 25 bips. Maybe they'll just pause and leave it here for now. I also don't really see that as an option. Obviously, depending on what happens this week with the data, but yeah, it'll be an interesting one, and I think that we'll have significantly more clarity by the end of this week, just to see how the inflation print comes in, and B, how the actions that the Treasury and the Fed took yesterday impact markets this week. That'll wrap it up for us here at Fed Forecast. We'll pass it back to Alejandro.
All right, guys, the futures are moving right now, trading. I mean, this is crazy. We looked last night and we were talking about it in our group chat, saying, look at the futures. Everybody that was short is getting stuck, trapped. And now here we are back down, and the landscape has completely changed as we continue to flush. That's just speaking to the volatility that we'll likely see this week. And we have CPI tomorrow. Oh, man. All right, let's talk about the system. I'm going to share my screen. We'll run through this quickly. So we are in oversold territory, 100 points extended from the 50th May on the 30-minute chart. From when the system gave the sell signal up here, looking at the 30-minute chart, we sold off 150 points. Now, bears are clearly in control, but something that's very important to note, the price action over the past couple of days, I was just talking about it, has been extremely volatile, and we have CPI tomorrow. So what does that mean? For me, it's going to mean proceed with caution, okay? The reason I say that is because a lot of these quick moves, a lot of these large intraday and overnight, as we saw, price swings can get you trying to do too much. So I came into today with a plan. I had my plan set, and that is what I'm planning on following. There's going to be a lot of opportunity to make some good trades this week, but you got to be able to stick to your guns. Otherwise, you can get sucked into all the noise. So the plan is to trade the chart, to trade the levels. Based on the system, what is it that we're seeing? We have the 10 SMA on the 1 hour chart coming down. That's going to be our trend resistance. We have the 10 SMA on the 30-minute chart coming down. That is also serving as trend resistance. So we'll see where we open up. Now that the futures are trading lower, it looks like we're going to get a gap down, which will open us up below the 10 SMA on both time frames. So bears are in control below those levels. And watch the 50 SMA on the 30-minute chart as it starts to put in a really strong downtrend, and watch for the hourly 50 SMA to do the same. Now, going into tomorrow, because we have CPI in the morning, it's going to be important for me to either be in profit or in all cash and to not open a position prior to CPI, because we know that that's going to move the markets, and it's really 50-50. Probably less than 50-50, because sometimes it doesn't go anywhere. They take your stops, and it's hard to trade. Okay, so that's what is going on right now in the system. Let's go over to Ramsay Rippers for Bet the Bell. That's going to do it for the system. I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys. Good morning, guys. Let's do it. Bet the Bell. Great segment coming today. We're going to start off with green or red. Let's go into the stats, see how the team did last week. Take a moment to digest. Nothing too different. The boys are performing well. Once again, Mo not really performing well, but he's trading well, so it doesn't really matter. All right, let's get right into it. The market is absolutely dumping. It's funny, about 20 minutes ago, I was looking at it. It looked fine.
Oh my gosh.
We were going to have a pretty solid range for green or red question. As of right now, the market's down a little bit over 1%. I'm just watching the red candles continue to dump. Testing 380 here. Got about 5 points to make up if we want to finish green from where we're trading at right now. Green or red today, Hondo?
Red today. I'll go
Diamond.
red.
I'm also going to take red.
Mander.
I also have to take red. VIX is up at 30 in pre-market right now.
Really? That's crazy.
This is crazy.
Where did we close? Like 24 yesterday yeah, VIX was moving on Friday. I was very surprised how wild it was moving.
Yeah.
Mo, red.
Red, man. Market's so fucked, dude.
380 test incoming right now. It'll be interesting to see what happens here. Small bounce. Let's get into our second question. Ryan, please pull up the XOM chart. This is a name that and really a sector overall that a lot of the guys were paying attention to coming into the year, looking for a rollover. It just wasn't happening, continued to trend higher, reaching that high of just basically 120. Current range for trading is about that $20 range from 100, 102 level up to 120. Looks like, XOM, this energy is starting to come down a little bit here. Looks like we're entering the bottom of this range that we're trading in. You guys think that it's about that time where energy starts to roll? Money Mander.
I'm actually going to say that energy outperforms over the next couple months here. I think last week, as we're seeing that roll, it was really just a full risk off where all stocks got dumped and people were flooding to bonds. But just due to the sticky inflation, I think this still outperforms tech and some other names.
Diamond.
Mander makes some good points. I think if the market as a whole wants to trade lower, I think energy could see it as well. Like, while they may still outperform tech, like Mander said, I think after the year that they had last year, I mean, you got to be the risk reward, in my opinion, at least, is to the downside for energy.
Sure. And let's go Hondo or Mo. Who wants it?
Mo.
What's the question? Is energy gonna roll today?
I'm not paying attention. Mo's paying less attention. So
no, the question
I'm
was
just looking at this market, man. It's just anyways. Sorry, what was the question?
XOM is starting to, if we pull up the chart, it was a name that we looked, a lot of us were looking short side coming into the year. I believe coming into 2023, big banks had the largest short open interest on the energy sector. XOM is starting to roll a tad off of that high of year and consolidation range between 102, 120. We're coming down to the bottom of this range, the lower half of this range that we're trading in. You think XOM and the energy sector as a whole starts to roll after just the strength we've seen over the last year?
I will say this: if it closes below 102.35, yeah, we're coming down pretty hard. But yeah, we're nearly there.
Yeah, we got some, I guess, some weights. Actually, I didn't see how down it was in the pre-market. Down to 104. Wow, almost 3%. All right, last question of the day. Ryan, pull up the tweet. We're going to stick to the financial sector. So state regulators closed the New York-based Signature Bank, ticker SBNY, on Sunday. Now the third largest failure in U.S. banking history, 2 days after the shutdown of Silicon Valley Bank, as Mander and Diamond stated on Fed forecasts, stranded billions in deposits. Treasury put out a joint press release last night outlining the government's response to the recent developments. Key points were basically that depositors at both banks will be made whole, effective immediately. The Fed will make additional funding available to the banks through the discount window, and the Treasury set aside money for a bank term funding program through the Fed that will allow banks to get additional funding as needed. Guys, is it time to panic, or should we relax? What's the take here overall on the financial sector and these banks in general, Mander?
So I think the Treasury and the Fed have kind of made this precedent, as this has happened in the past, where although depositors are only insured up to $250,000 per account, they've really made a precedent here that they make everyone whole regardless of the amount. I mean, Roku had almost $500 million sitting in Silicon Valley Bank. So I think, the consequence of not making them whole is worse than just paying out more than you were insured for. So I don't think it's really necessarily time to panic yet. The one thing I wanted to mention on Fed forecast as well, though, we haven't heard anything from Credit Suisse recently since that late night call with the SEC and the FDIC. So if Credit Suisse were to go down, I think that is a big enough player to cause some dominoes. But right now, it's just your small regional banks. I feel pretty okay about Goldman Sachs, about JP Morgan, about Citibank for now.
Diamond.
Is there like a specific question or just banks in general?
Yeah, and I mean, is it time to panic? And what's your outlook as far as just the financials and banks in general as a whole?
Yeah, I mean, I agree with Mander. I think that what they did yesterday was pretty substantial. Obviously, I guess we'll have to see how that plays out this week. But I mean, the idea is to get enough calm where this doesn't spread. like ridiculously. Like I think that you can make the argument because I saw a lot over the weekend of people really like sticking it to SVB and how these people didn't do their due diligence, and whether or not that's true, I'll leave to people who are much smarter than me. But I think at the end of the day, one thing that you can't deny is that really any bank that's not maybe like one of the top 4 banks is susceptible to something like this, just with the speed of how money can move nowadays, right? I think that when the Fed does these stress tests like they've done in the past, they base it off of, these things sort of spreading by word of mouth, people having to go to their bank, withdraw their money, and even that takes some time. There's some friction in that system. I don't think that they've tested half of your customer base going on their app and wiring their money out of your account into another account. That takes 30 seconds. Like that realistically could happen anywhere. So it's like, I hope that this works, and I hope that we don't really see any more of what we saw on Friday and Thursday, but I don't think that you can really be sure. My gut feeling is that it will work. So that's what I've got.
Appreciate it, brother. All right, that's going to do it for Bet the Bell. Let's pass it back to Hondo.
All right, Mo. Mamba market analysis. Let's do it.
I'm going to go ahead here and share my screen. It's massive. They were just infamous trend line right here. All right, guys, good morning. So this is probably the one time I don't want to do this analysis. So this market is so frustrating, man. I'm usually stacked short, and I don't have but fucking forward short, swing short right now. So that's why I'm kind of frustrated this morning. But let's go ahead and get in with, and we have 2 days till market crash, right? Chat GPT, baby, let's go. So I mean, with this rollover, I definitely think we're going to come down and hit 379. Remember, guys, in the December, what was this? The last 2 weeks of December were just brutal, right? Into January, into the first week of January, we're just brutal. This was just absolutely nasty right here. Of just 2 weeks of just chop on the daily. That's what you get on your 5-minute. We got this on the daily time frame. And this was brutal for swings, right? So, but the range we got stuck in, this 379 up to around 386, that's the range we were in. I'm going to target 379 today. If we close below that, I'm going to have to target somewhere around 370. You really don't have any clean support till then. Maybe you'll get some support at 372.2, but I'm going to go ahead and target this 370. If we hold this 379, I will like this to come back up. I'm just really hoping, man, they give us another pump here into this market through. When we come up here to this 3.5 level. This is a really good level to look for. I do hope we come and bounce off this 379 and they rip us into that 350. If we just get that today, right? Maybe we don't come down and see this. If we just come through here, I'll have to watch this zone here where we close out. If we do close above, or if we do reject here, test this, reject, I'll take a swing short back into at least this zone. And then if we get through, I'll hold and come down and back into this level. So for now, my big watch is, can we get down to 379, confirm support, and then make a move back into this supply zone on the daily. So big key level 379, that's what to look out for today. Thanks, Hondo.
All right, thank you, Mo. Now to wrap up today's show, we're going to do member of the week. So this particular individual is somebody who I have been seeing spend a ton of time working in the Discord. It's FinCat. Ryan, let's run the graphic and then we'll let Noah. I don't think I've ever seen the picture that big. That's a ridiculous looking cat.
It's an awesome picture. But yeah, FinCat's been grinding.
Great job.
Yeah, he's been grinding, working really hard to improve his game over the past several weeks, and we've definitely seen that development. So really proud of you, FinCat. Wanted to get you some recognition up here for the hard work that you've been putting in. Keep killing it, brother.
All right, awesome stuff there. Keep working, FinCat. You're the man, or the cat, whatever. All right. That's going to do it for this morning show, everybody. Thank you for joining us on Beat the Bell. This is surely to be an action-packed week, and we will be here today, Wednesday, and Friday to keep everybody updated. We'll be trading live as well all day, every day in the Kane Capital Discord. You can go to kane-capital.com to trade with us. We'd love to have you guys. We got a 7-day free trial going right now. Let's get into it, guys. Have an awesome week. Manage risk, trade smart, and we'll see you back here on Wednesday morning at 8:30 a.m. Eastern time. Have a good one, everybody.